Thank you, everyone. We don't have a quorum yet, but we don't need one since we're not voting on anything today. So I'll go ahead and call the meeting to order. And Preacher, would you mind opening up with a word of prayer, and we'll get started.
I'd be glad to.
Thank you.
17. Let's pray. Father, we thank you for such a beautiful day. Thank you for this time of the year when it seems like things come back to life. And Father, we just pray that you would bless us now as we deliberate, as we get facts, that, Lord, you just make our mind receptive to the truth, and that we make our decisions based on that. Thank you for all that you do for us. In Jesus' name, amen.
Thank you, Preacher. Wisdom needed and welcome. Senate Bill 448 has obviously generated a lot of interest. And what I wanted to do, what I hope to accomplish today for the committee, now again, tomorrow we're having a hearing on Senate Bill 448 itself. We have the room for 2 hours for those that are interested. We'll have an hour for the presenter and those that are for, and we'll have an hour for those that are opposed. Tomorrow we'll be hearing Senate Bill 448. Today, what I have done is invited the banking commissioner, Mr. Browswell, to come talk to the committee about not the bill itself, but the subject matter that the bill pertains to, successor creditors. I think I asked him to explain it kind of like you, well, I won't say what I said, like a biologist would be explaining the ecosystem and how everything fits together and works together and how it all works, because it can be a complicated subject. I wanted the committee to be informed going into the hearing tomorrow so that we would have the knowledge that we need to make a determination on the merits of the bill and the issues that we may have with it. At this time, I don't think we have 12 members here right now, do we? 1, 2, 3, 4. Nope. And I mentioned some of the members. One thing I want to do is to change our quorum from 12 to 6. In these remaining days, there may be things we have to take care of, and everybody has committees and hearings all over so I think it will be helpful. Once we do get our quorum, then I may interrupt the testimony to take care of that quick business. So with that, Commissioner Braswell, if you would begin and just, that's fine. Yes, that's okay. Witness mic up here. Number two. And if you are ready, you may proceed.
Thank you, Mr. Chairman. Good afternoon, and good afternoon, members of the committee. As Chairman Morris has said, he's asked me to come today to provide background information and context to the committee regarding the issue of banks selling loans to the secondary market. And in this case, I'm referring to the secondary market as anyone other than the original lender. Chairman Morris has also asked that I give you a brief update on the status of banking in Georgia, and I will do that during the second half of my comments as well. Regarding the sale of loans, it's not uncommon for banks to sell loans to both private investors, such as DebtX, First Financial Network, or even Fannie Mae, or to public investors, such as large publicly traded banks. The reason that a bank may sell a pool of loans is that it's a very effective tool that allows a bank to accomplish a number of things, such as, and these are the primary factors. Number one, to recalibrate or manage its balance sheet to fit its business plan, to stay within industry norms, or to reduce regulatory concerns. An example would be the distribution of its loan portfolio may no longer fit its current business plan, just as an individual from time to time has to recalibrate its investment portfolio. You want to make sure you have the right distribution. Additionally, regulators are strongly recommending banks to reduce all types of concentrations, especially in this market. You can imagine real estate concentrations. Number two, to boost liquidity. The bank basically, when they sell a pool of loans, is reducing their longer term assets and in turn turning that into cash for short-term obligations or needs. Again, there are regulatory requirements regarding liquidity, and so a bank may utilize that tool to increase their liquidity. Number 3, to meet or improve regulatory required capital to assets ratios. A bank can sell loans as part of the equation to reduce its asset size, which in turn improves its capital to assets ratio. As you can imagine, capital this much of a balance sheet, assets are here. When you sell some loans, you may take a hit, have a shortcut or haircut on some of those sales, and so your capital is reduced slightly, but your assets reduce greatly, improving the numerator to denominator ratio, thereby improving your capital to assets ratio. Number 4, to improve profitability. It's been a challenge for banks to find new solid loans to add to their portfolio to boost the bottom line, especially in this environment. But they can sell some of their problem loans that are a drag on earnings and reinvest those funds in better yielding investments, new loans, securities, that sort of thing. Number 5, to reduce the level of problem assets as required by regulators. Bank regulators, both the federal regulators and state, are requiring banks under formal and many times informal administrative actions to reduce the bank's percentage of non-performing loans. We have currently 195 state-chartered banks in Georgia. 60%, that's 118, are operating under either a consent order, which is a formal administrative action, or a memorandum of understanding, which is an informal action. Far and away, the vast majority of these actions require a scheduled reduction of problem assets. Number 6, to enhance the ability of a bank to raise capital. Potential investors are not interested in buying a bank stock as long as the percentage of problem loans to total loans remains above acceptable thresholds. Banks may sell a significant portion of their problem loans, thereby making the overall quality of the remaining loan portfolio much better than it was prior to the sale. With a cleaner, more solid portfolio, a bank's ability to attract potential investors is greatly enhanced. I'm sure this is not an all-inclusive list of the reasons that banks sell loans to the secondary market, but these are the primary and vital reasons that they do. Here are a few facts and figures to give the committee some perspective on the need and use of this tool. It will also reflect on the current banking environment in Georgia, which I spoke to earlier. In 2008, there were $13 billion in non-accrual assets sold nationwide. In 2009, the number was $14 billion. In 2010, the number was $30 billion. In 2011, there were $22 billion in sales. So you can see this is a tool that is being used significantly. In fact, a Georgia state-chartered bank was the 14th largest seller of non-accrual assets in the fourth quarter of 2011. Regarding Georgia state-chartered banks themselves, at the beginning or the end of 2006, which was right when the market started to turn and life was different as we now know it, there was $1 billion in non-performing assets on Georgia's banks' books at that time when the market began to tumble. That was at the end of 2006. Non-performing assets equaled $14.8 billion at the end of 2010. Again, from $1 billion to $14.8 billion, which in 2010 was the high water mark for non-performing assets on our bank's books. Please keep this in mind. This is after well over $1 billion of problem assets had been sold to the secondary market. So after those sales, we still had $14.8 billion on the books at the end of 2010. As of the end of 2011, non-performing assets equaled $12.7 billion in Georgia state-chartered banks. Again, this is after hundreds of millions of dollars of problem loans were sold during the year. Just to kind of reiterate, again, out of 195 state-chartered banks, 60% are operating under either a consent order or an MOU, a Memorandum of Understanding. I can't speak to the 43 national banks and federal thrifts. in Georgia, but in speaking with my federal counterparts, I understand that the situation is very similar to the state-chartered banks. The state of Georgia, including both state and national banks, has experienced 78 bank failures since 2007. About 23% of state banks have failed during this time, and 20% of national banks and thrifts failed during this period. It's not surprising that a higher percentage of state-chartered banks have failed, since the vast majority of banks chartered over the last decade were state-chartered institutions. The OCC moved its office some time ago from Atlanta to Dallas, and after that we definitely became the charter of choice. These young banks were impacted the quickest and most severely when the real estate market deteriorated. The financial industry in Georgia is improving, albeit very slowly. The worst appears to be behind us. More banks are returning to profitability. The level of problem assets has stabilized and in some cases diminished in many banks. Regulators have upgraded a few banks due to improvement and taken a few banks out from under enforcement actions. Unfortunately, I'm sad to say there will be more bank failures. However, it appears that the rate of failures has slowed. In conclusion, I hope my comments have provided the committee members with perspective regarding the improving but still vulnerable status of banks in Georgia, as well as the criticality of a bank's ability to sell loans or problem assets to the secondary market. Any regulation, any legislation, or any other factors that could affect a bank's ability to sell to the secondary market could, and likely would, have a tremendous negative effect on the financial industry in Georgia and the communities it serves. With that, Mr. Chairman, I'll be happy to answer any questions that the committee may have.
Thank you, Commissioner. First, I want to handle that little bit of business. We've got plenty of a quorum. What I'm asking, and I appreciate the attendance, I sure do. Everybody's awfully busy, as I stated before, folks who just walked in, and I was going to ask the committee if it would be the pleasure of the committee, I would like to change our quorum from 12 to 6 members, given that here late in the session we all have to have a lot of places to be. So I would entertain a motion to that effect if it was the pleasure of the committee. No. All right, we have a motion and a second. Any discussion? Those in favor of the motion signify support by saying aye. Aye. Any opposed? No. Thank you. That motion carries. Okay. Commissioner, let me go ahead and let a couple of the committee have questions. Who's number 24? Oh, Chairman Knight.
Thank you, Mr. Chairman. Commissioner, thank you for your presentation. It's been a while since I've been in this industry, but I guess in regards to your comments, and I want to make sure maybe we can elaborate on those, and because I know that one bank failure it hurts our community, and I know we've experienced this all over the state of Georgia, and as you said, we may have more to come. So any action that this committee or this legislature takes in regards to helping or hurting our banks we need to do it wisely. So I want to go back to your points and see if you could elaborate more, perhaps refresh me, as I haven't been in the industry in a while, and maybe our members go back in detail as to what this potential legislation would do in regards to, there were 4 things, and I think they tie together. You know, when we talk about boosting liquidity, we've got our capital asset ratios, reducing, non-performing loans, and then, enhancing a bank's ability to raise capital. Obviously, these all have to do with, when we're audited, when we come in, we may be under federal, state guidelines to meet these ratios, raise capital. I know we're hearing that in our community. Can you elaborate on that a little bit more to make sure that we understand what the banks are looking at when they come in with their auditors in regards to meeting these I guess findings that they're given by the auditors?
Well, we have, as I mentioned, 118 banks that are under some sort of action, either formal or informal action. The vast majority of those require certain thresholds to be met, capital to assets ratios, certain capital ratios. And so this is a tool, selling to the secondary market is a tool to help meet that. You basically are shrinking the balance sheet to do that. Also, many of our banks are on a liquidity reporting status to us, some of them monthly, some of them weekly. That's where we're very concerned. Most people may not know this, that the real concern with a bank failure is not when it's insolvent, it's whether they can't meet liquidity needs, cash letter. And so that's why liquidity is such a hot topic with regulators, and so there are liquidity thresholds that we require in these consent orders as well. And then also, just to ensure they're cleansing their books and getting these problem loans off the books, there's a reduction schedule of problem assets on their books. And there are various ways to get rid of those. You can foreclose and sell the ORE. You can sell them to the secondary market. Hopefully you can rehabilitate a few and make them where they're not problem assets. But a tool in this environment, while it's been so severely impacted, the real estate market has been so severely impacted, a tool that has been utilized by many of our banks, especially the larger publicly traded banks, is to sell these to the secondary market.
And one more follow-up. And so, well, a follow-up comment, but also another question. But you're saying in this is a very important tool for these banks and for a lot of the banks who are right now on the verge of they're in trouble. Let's put it that way. Is this one of the first tools they would use? How important is this tool? And that's, I guess, a follow-up question. And there's one more tax question that I've got, if you don't mind. When we talk about, the bill is talking about guarantees too, or the guarantors of these loans. I've got a question. From a tax perspective, when is the forgiveness of debt triggered, and who is it triggered to? That's one of my questions from a CPA perspective. So,
well, and I can't answer that question. That's out of my area of expertise, and also we're trying to, I think, stay away from the specifics of the bill today. But I wouldn't be able to answer the tax question. Regarding the first question, I think it is a very vital tool to some of the institutions that have utilized this. It has been critical, and I think, who knows, but I think has been, if they did not have the ability to do that, their viability would definitely have been jeopardized. So that's how critical I think this ability to sell to the secondary market is.
Yeah, and let me acknowledge too. Now, the banking commissioners here, but the committee and I'm aware that other loans are sold as well. There's other industries that are interested in the legislation. Here we're speaking to the banking industry in Georgia, so we're aware that there are other industries to where these notes and debt obligations are sold. So we're aware of that. Let me, and I'm keeping up with the questions. We're going to get to everybody, but let me ask a scenario, and maybe, and this is what you hear a great deal. Why a note is sold? And you talked about some of the reasons why it could be, and this is the rub. I think when it gets down, let's just say there's a $10 million loan. An individual is making the payments on the loan. The loan is current. How often are we in the scenario, it's not the bank's decision, but it's a regulatory decision, say by the FDIC, that they need to sell that loan? I mean, why would they want to sell that loan at that point? I guess, is what a lot of people get to. Under what circumstances do we get there? I mean, most people don't understand, and I want you to clarify. When there's a performing loan, when I say a performing loan, when somebody's current
Right.
on their loan, under what circumstances does that change? Could that change?
Well, that could be looked at several ways. There's sometimes a difference of opinion as to what is a performing loan, as you mentioned, that you change it to current, because there are some loans in which the interest reserve is built in, and so it may be the project is not cash flowing, but because of a reserve that was set up at inception, the note is still current. But collateral values have since dropped. It may be a subdivision in which you have the PVC farm, as they call it, where nothing is being built, there's no activity, that sort of thing. So the loan could actually still be performing or current, if you will. I'd say, let me take that back. It's still current, but not performing based on regulators' definitions. And so that would be a term, that would be a loan that perhaps would look to be sold, as well as perhaps it is a loan in which they already have a large concentration and are trying to reduce that concentration. And so again, maybe a reason they would want to sell that loan.
It would be to comply with a regulatory decision, most likely from the FDIC.
But regulators do not state a bank must sell this specific loan. Federal or state regulators would not state, this loan must be sold, something of that nature. The consent orders and the informal orders and directives are not that specific. But it would ask for a reduction of problem asset schedule. And so it would be up to the banks to determine which, how to reduce those problem assets.
And that can be a very tough decision.
Sure. You have to, there's all sorts of thought processes that have to go into it. You have the current value of what you would receive on the sale of this versus perhaps future earnings based on reinvesting those funds, that sort of thing. What does it do? Do you have sufficient capital today to take a haircut on these sale of loans? But then you also have to weigh that to how does it position us to attract future capital if we're starting to cleanse our balance sheet. So there are lots of factors that factor into whether a bank sells a pool of loans or not.
Okay, we'll come back to that. Let me hear, is that Representative Smith? Representative Smith.
Oh, thank you very much, Commissioner. Thank you for being here today. I just have several questions, if you don't mind. First, let me preface it by saying that I met with some of the bankers in our region, and prior to our getting any type of in-depth conversation, their descriptive explanation of this was the burgeoning fiscal train wreck. And that's before we sat down to even talk about it. But let me ask you this, and please know I have experience in this as well. Why would the sale of problem assets for banks not be problem assets for the secondary purchasers?
Well, they're buying them at a discount, first of all. And so they are weighing that into the equation as to how much they bid or how much they negotiate, what kind of price they negotiate when they do that. Just as if you buy anything else in a distressed environment, you're going to get a good deal on those.
Okay, another question. Who would you define or classify as being the secondary market in the event of the regulatory impropriety process? Who is the actual secondary market?
It's made up of both public and private companies. There's, as I mentioned, a few of them. I think DebtX and Rialto's one, First Financial Network. Some consider Fannie Mae a quasi-private entity. So, as well as public entities, could be other publicly traded companies, large publicly traded banks, publicly traded insurance companies.
Okay, in the event that we, just in the event that we happen to get back to the trauma of what occurred a year and a half, a couple of years ago in the banking industry, exactly for the state of Georgia, who is the legal regulatory enforcement entity that would ensure that what is occurring would not occur?
say the last part of your question, then what has occurred will not occur again?
Yeah. Who would be the entity to ensure that there would be no improprieties with respect to the transfer of problematic or bad assets to a secondary purchaser? Who would be the enforcement arm?
Once the note has been sold off a bank's books and that transaction has occurred, it would no longer fall under the regulators and would not fall under the state regulators, because we're concerned with just what is on a bank's books, what is on a bank's balance sheet and their practices. But once that has been sold, that would not fall under our jurisdiction. So I don't know the answer to your question as far as following that down. I assume any other commerce type transaction, wherever it falls under, that would fall under that as well.
Okay, thank you.
Mm-hmm.
I think Representative Flood, I believe you were next.
Thank you, Mr. Chairman. Thank you, Commissioner, for being here. Can you help us with the sort of the size and scope of this issue? So how much of both performing and non-performing loans are sold in the secondary market? What percentage of loans made are sold in the secondary market?
And you may have not been in when I first mentioned, I've got the numbers nationwide for the last 4 years. Starting in 2008, it was $13 billion nationwide, then $14 billion in 2009, $30 billion in 2010, and $22 billion in 2011.
How about for Georgia?
For Georgia, I'm not aware. I don't know where you can gather that all in one case. I am aware of anecdotally well in excess of $1 billion sold the last 2 years by Georgia publicly traded companies. Probably several multiples of that, but I'm aware anecdotally of in excess of $1 billion.
If you could put that in terms of the percentage of those loans that are made, the initial loans, what percentage of those loans are then sold in the secondary market?
I don't have that number. I don't know.
It's the last question, and it has to do with when banks are taken over by the FDIC. I understand that the FDIC has the ability to negotiate the sale of those assets from the failed bank. And so the FDIC is engaged to some extent in offering those loans in the secondary market. What kind of best practices does the FDIC utilize to ensure that the loans are being sold to appropriate secondary borrowers?
Well, let me tell you, the way they do that, when we go in, it's on a state chartered institution, and we close the institution and we hand it over to the FDIC in receivership. Prior to that, most cases, all but just a handful of cases, an acquirer has already been secured. In that case, that was part of the bidding process with the acquirer. And so ideally, the FDIC doesn't want to have assets to manage going forward either. And so they try to attract a bidder that will take those assets, and they negotiate a lesser amount for the institution to take those assets. In the rare or the few circumstances in which there was not an acquirer, then the FDIC has those assets and has to do something with that. From my understanding, I believe the FDIC has basically a partnership with two companies that are kind of I guess you'd say in the debt liquidation business. And so they deal primarily with those entities to have them sell those into the to the market, if you will. So that way the FDIC does not have the resource or the time to manage those assets. And so they work with those companies to do that. I don't know as far as the arrangements they have with those companies as far as a checks and balance or something of that nature regarding how those companies sell those loans. That'd be a question for the FDIC I can't answer.
Thank you.
Mm-hmm.
I'd better not say that. Let me move on. Who's next? Not on what you were saying, but that's something I thought of.
Thank you for clarifying that.
Yeah, just the unfairness of certain FDIC policies. Representative Frazier, yeah, you were next.
Thank you, Chairman. Thank you, Commissioner. Thank you for Banking 101. Appreciate that. You pretty much answered all my questions. I just have one question. Other than the real estate, what are other problematic loans?
The vast majority of pain that has been caused by to our banks it has been real estate related. By and large, anything else would be so small in comparison to the real estate. You know, it was expected, I think, that the commercial and industrial type loans would also, some of the business loans would suffer. There has been some of that. There has been an uptick in that, but it has not been nearly as severe as was predicted by some economists. So, like I say, real estate loans, the subdivision loans, the acquisition, development, construction loans has been the downfall of our institutions.
Thank you.
I guess the thing that, I'll go ahead and say it, the thing that's tough, and we're doing our best to understand a rhyme and a reason to FDIC regulations as it involves banks. And I sit and think of a South Georgia bank from 1929 until 2009. Never had a losing quarter. Pretty darn good record. A lot happened between 1929 and 2009. All the investment of the investors are gone, including the family that had basically owned the bank since 1929. That president is out of work and had a severe financial loss. I understand there was bad decisions made. But then Lloyd Blankfein has his job at Goldman Sachs, and it took $25 billion worth of taxpayers' money, and he still got his job, as does Jamie Dimon and all the rest. That's the part that we as community banks have found tough to understand the process of the FDIC involved in this. And what I want to hope that we can drill down to today by the other questions is the role in the FDIC and what could be done to change directions in the results of everything we hear today. Because I've heard different people for and against, but I don't think anybody that's for it or anybody that I talk to that's against it has really caused the trouble.
What?
All right, you can comment on that at all, and I, like I said, I'm not asking you to apologize for them, and I'm just that's the thing that it always comes back to, right, is the policies that put us where we are today and aren't helping the situation.
Right. I understand the frustration, and just not to speak on behalf of the FDIC, but we do have a very close working relationship with our federal counterparts, and especially during this time, the FDIC. We are on an alternating examination cycle with them, but during this crisis in which we have so many banks with troubles, and both our agency and their agency having limited resources, we have most of our examinations are now done jointly during this time. So we have a very close working relationship, and I'm in contact, and our staff is in contact with the FDIC's Atlanta regional office, which governs or has jurisdiction over the southeast for the FDIC on a daily basis, basically. I do know, I think they share some of your same frustrations, because a lot of their discretionary authority has been taken, has been put up at Washington now. Some of the decisions that used to be made at a regional level are made up in Washington now. The good news, I think, or potential good news, is that Acting Chairman Martin Gruenberg, the FDIC chairman, has stated and held hearings, I believe, regarding community banks and as well as credit unions, regarding the impact that some of the regulations and laws have had on them, to try to find solutions to some of those that may have seemed like a good idea at the time, but have not worked out as the regulators had intended. And so I know that they are having meetings as well. Also, the Conference of State Bank Supervisors, which is basically 49 other of my brethren, we have developed a community bank committee in which I'm on that committee, and about 19 other commissioners on that committee, and we meet every 2 weeks via telephone to try to come to ways that we can find that either state or federal laws or regulations are impacting community banks' ability to serve their communities. How have we gotten in the way, and what laws or regulations have become antiquated and are having the opposite effect of what was intended? And so we've gotten feedback from our respective state banks regarding that. The other commissioners have done the same thing to try to come to some solutions. And so we're working on that. I know that doesn't address the concern of today that our bankers are feeling, but I am very empathetic to the compliance and regulatory burden that our bankers are feeling. With the passage of the Dodd-Frank Act, yet there's additional compliance burden that was passed along to bankers. You know, you shouldn't have to have a $70 million institution, shouldn't have to have 3.5 people on its staff just to ensure it for compliance needs. That's ridiculous. So those are I share some of your frustrations, if I may.
I've heard. Let's go on. Let me move on. Who's next? Representative Nix.
Yes, thank you. Appreciate the information. It would be helpful to me and maybe to some other people if you could walk us through a scenario of a loan. Let's just say we had a developer who, when times were good, had a $10 million loan. At that time, he maybe had a $20 million net worth, basically in real estate. He guaranteed the note fully, or the bank never would have made it. Now, everything's gone to hell in a handbasket. That loan has been sold, and they're trying to collect. Walk us through the steps of what will happen to the bank and the borrower in this collection scenario.
The bankers may can speak to that better. If the bank has sold the loan, it's in the secondary market, that new purchaser can go against the guarantor for the balance of that loan, for the original amount of that loan. I mean, it's very. My understanding is very simple. Like I say, once it has been sold, that acquirer, that guarantor's guarantee stays in place, and that and was bought based on that knowledge, and will seek payment from that guarantor.
Okay. Can I follow up? We know the story about the blood in the turnip.
Right.
The turnip doesn't have any more blood. Let's say that they're able to take that $10 million loan that was out there, and they're able to sell that distressed property, and they get $4 million for it. There's 6 left. Our guy that made the loan has virtually zero assets now, so they can take him all the way to the wall for the full $10 million. Even though they bought it for cents on the dollar, they've maybe doubled their money, but they can still hold him accountable for the full $10 million, and that's what they're doing. Is that what's happening in practice now?
That's my understanding. They would seek judgment against the difference between the $10 million and the $4 million or $6 million. I can't remember which you use.
Okay. Thank you.
Maybe really quickly, why would a bank not be allowed? Your scenario was he bought it for $2 million. Usually the turnip has a little blood. Why wouldn't the bank be allowed to have the borrower involved in the process of buying the distressed note? If he were to offer $4 million, and on the debt market it only gets $3 million, why is the FDIC, as my understanding, does not allow the borrower to purchase?
Some of those regulations you speak of regarding the FDIC, I think all that was the impetus behind that was the S&L crisis back in the late 80s, early 90s, where many of the individuals that were responsible for an institution failing were then buying those assets at a huge discount, and so it was somewhat self-serving to do that, and
Yeah.
so I think the regulations were changed regarding that, so that would not be the case due to the the individuals that were responsible were getting these deals.
All right, maybe come back in a few minutes to loss share versus the ones that the banks took over in relation to that question. Mr. Peake, I believe you're up next.
Thank you, Mr. Chairman. A couple of quick questions, then I'll get to the heart. Did you say 60% of loans? Did I hear that right? 60% of banks, 60% of banks in our state are in consent order or in
Memorandum of Understanding.
Yeah, is that right? 60% of banks.
State chartered banks.
And the selling off of the loans is a key issue in keeping the bank viable. Is that correct? For liquidity purposes.
For many of our institutions, that has been a tool utilized to maintain the viability.
Okay. I want to kind of piggyback off where Representative Nix was going. Maybe I missed the last part of the question. $10 million loan bank owns. Let's say a bank and it's a performing loan. But, or let's use personal. I borrow $10 million secured by my restaurants. I'm performing on that loan, making payments, but all of a sudden appraisals come in and say that my real estate's only worth $5 million now. Does the bank has the right to go sell that loan, whether they're performing, whether they're under a consent order or not? The bank would have a right to go sell that loan. Is that correct?
Correct.
And if they were to sell it for $5 million to a Rialto, they would get $5 million at that point, but I would remain on the hook personally if I'd guaranteed it for $10 million. Is that correct?
Correct.
And okay, so okay, I just want to make sure.
I think you got a grasp of what happens.
Yeah.
There's not a windfall to the borrower just because that note is sold.
Okay, but getting back to Mr. Chairman, if I can, to kind of where you were going. So me as the borrower, I would, by FDIC requirements, would not have the right to go back in and say, okay, wait, well, let me go negotiate with another bank and I'll pay $6 million and pay that off. Am I understanding what I was trying to get to what your question was?
Yeah. I'll let him answer it, but again, because you saying the rules were changed in regard to that because of the S&L crisis back in the late 80s.
Right.
That there was fraud involved in those type of transactions. But I guess what you're getting at, when somebody's under a consent order or memorandum of understanding, you're not only partnering with the FDIC, us too, the state's regulators. So I don't see how
so that's
fraud would occur under that circumstance with that level of
But
scrutiny.
it's prohibited. Am I understanding that by
I don't know if it's statute or by policy or what is it. Could you say?
It's the FDIC. I don't know whether it's by policy.
I know you're in a position
right.
of you don't represent the FDIC,
right.
and I understand that. But right. I'm again hoping everybody we're getting the context
right.
of why we're here.
The scenario like Representative Peake mentioned, though, if it's a performing loan, and like I say, not just current but performing, most likely they would not sell the loan. If they wanted to,
but if they were
you leave, they would first discuss with you as far as moving the debt elsewhere.
But if they were on a consent order, they would be motivated to potentially go sell that performing loan. Is that right or not? I mean, no. I mean, if they needed it for liquidity purposes.
That is a tool they can use. The consent order would not require them to sell that loan, that sort of thing. The consent order would simply state, like I say, there's a problem asset reduction schedule that would be put into place, and this one sounds like it would not be a problem asset, so it would not be required to be sold. They could use it to boost their liquidity or to shrink their balance sheet. They may choose to do that, but the regulators would not be forcing them to do that or coercing them to do that.
Okay, Mr. Chairman, can I have one more follow-up?
Keep going. You're doing good.
I tell you, I've been hearing from all sides on this bill, and I'm a borrower. I mean, I borrow a lot of money. So I understand the position of, okay, I've got a loan that I'm paying, making payments on, and then all of a sudden it gets sold for 50 cents on the dollar to somebody else outside. Okay, the bank made a business decision to do that. Then a year later, I'm crumbling for whatever reason, and therefore I'm on the hook for. I could have paid a little extra premium maybe to get the bank what they wanted. So I understand that from the borrower standpoint, and so I've got to be very sympathetic there. But I also understand that there's a contractual obligation that I made to guarantee that note up to $10 million. I get that. I understand that. Is there some type of middle ground that can satisfy banks in our state to make sure they can sell these loans when they need to a Rialto or another third party, but also give some protection to a borrower to be able to step in and say, I'll pay $10 more, and therefore not be on the hook for a guarantee that would potentially make them insolvent. I'm asking the question.
Right. And that's a good question, and I don't know that's one for me to answer, but like I say, I think it's a good question to ask. Something that I would throw as a regulator into the mix for consideration, though, is, and it's kind of a fact of life. We've brought up the FDIC here. They are the big dog in this fight, if you will. All banks in Georgia have to have FDIC insurance, and so if there's anything done that would impact Georgia banks in comparison to the other 49 states, I think as far as limiting the secondary market or limiting a bank's ability to sell, I think could be potentially damaging to the institutions.
By limiting that ability. Is that what you're saying?
That's correct.
Okay.
Like I say, I'm not trying to get into the legislation, but I'm just thinking if Georgia is an outlier regarding the way the FDIC's ability to find acquiring institutions or to dispose of assets, I'm afraid that'll have a negative impact on our institutions.
On an industry that's having a tough time anyway.
Still very vulnerable.
Okay.
Well, and that's the. I like this job.
I used to like
that's
mine.
I know. Well, like I told before, the knowledge I came by in all this wasn't the way I wanted to learn all of this subject. Speak makes an excellent point. I mean, everything rests on rule of law and contracts being honored. I don't think anybody really in this room, reasonable person, would deny that. This is what, let me put it this way. Don't point it. Let me put it this way. I appreciate your help in putting this study together and the new FDIC fella looking at these antiquated. What I would ask would they look at rule of law. I mean, and when it comes to the loss share agreements and the results of what has happened, well, we want our borrowers, you borrowed the money. These are the terms. This is what you agreed to, fine. But also people that went in and got certificate of deposits from banks at a certain interest rate, they had an agreement too. They signed it, and the bank signed it. But that's not honored because the FDIC allows that to be discarded.
Right.
We can't operate in the state of Georgia with one set of rules. With the FDIC in Washington and a whole lot of other people in Washington operating on a whole other set of rules. That's what I hope we get across, and we're all, and when we leave here, we're not just looking for a villain, but I'm saying that we are in this position because of bad policy from the people in Washington and the FDIC. I'm just going to say that. Who's next? Chairman Houston.
Thank you. I just want to make sure I understood this correctly. If somebody's current on a loan and they're making their payments current, y'all you will not classify that loan or encourage the bank to do anything about that loan. Is that what you said?
Loans that are considered, most likely, loans that are considered collateral dependent and the collateral has dropped precipitously, that loan could conceivably be current but still be classified as a problem loan.
All right. Okay, and so therefore they'd want to sell that probably.
That could be one that would be in their reduction schedule. That would be considered a problem asset, and that they would likely to sell.
All right. Well, why would someone want to buy a loan? It's a risk when you buy a loan in the secondary market. Why would they want to buy a loan if they couldn't make a reasonable profit?
And they wouldn't. That's a very good question. Like I say, that's why they would buy it at such a discount, so they can make a profit.
Okay. So this would just do away with completely selling to secondary markets of loans. This bill is that the way I understand it?
Well, I don't want to address the bill, if I may, but also
he will be invited if he would like to be a witness tomorrow to testify either for or against the bill. I mean, that's up to the commissioner.
I can tell you that answer right now, but that's what I'm
okay.
This will be enough today, I'm sure.
Yeah. Okay. All right. Who's next? What number is that? Representative Harden.
Thank you, Mr. Chairman, and thank you, Commissioner. This and I guess a lot of what I want to ask has already been asked. I guess one thing though I would ask, and I'm sure it depends on the individual loan and the circumstances, et cetera, what kind of discounts are we seeing on these loans?
I think that ranges across the board. I'm not that familiar with the amount of discounts for certain type loans, certain type entities that are selling those, as well as to what groups are selling them at. So I think that fluctuates significantly.
Right, and the reason I ask, when I was mayor, we borrowed several $1 million for a project in the city from Farmers Home Administration, who at the time was making loans to small cities. About 6 months later, they wrote us and said they were selling our loan to an investor at a 40% discount. Mm-hmm. Well, I had a local banker that was real good to me, and we actually bought our loan at 40% of its value 6 months after we made it. And I'm wondering if these loans are, if these discounts are large enough. I didn't understand why maybe the maker of the loan couldn't bid on that loan if he could get financing somewhere else to buy that loan at whatever the company is buying it at. But you seem to think that's against FDIC policy, is that?
Yes, sir. Like I say, based on what I understand, based on the S&L crisis in which that happened quite often, that was left a bad taste in many individuals' mouths, especially I think in Washington, and so that policy was changed so that could not happen. And so I understand, I have heard frustrations from borrowers saying they would have paid more from a DebtX or someone else than who they sold it to. But so they're very frustrated with that.
Well,
I've heard those anecdotal stories as well.
All right, and if I might follow up, I don't understand how, if you've got a legitimate bid on the table, the bank couldn't take a higher bid. I mean, how is that helping? How is that a problem? What happened during the savings and loan thing that caused to say, a borrower could not bid on his own loan?
Well, so many of them, like say, the individuals that were responsible for the failure of an institution had, were the ones that were then buying those loans, those assets at 20 cents on the dollar, and that sort of thing, and making profits off of those. And it kind of, as we spoke of some of the frustrations that people felt, they felt the same, frustrations with that happening as well. And so the policy was changed to prevent that.
So we couldn't do away with insider trading, so to speak, and then maybe open the process back up.
I
don't
know that answer.
Thank
Well,
you,
maybe if we put it this way, probably gonna get in trouble. All right, so that's why they have the rule, because it was kind of like insider. It was an inside game.
Right, abuse.
But if the FDIC has funded a secondary purchaser for the secondary market, basically, if they're a shareholder, as I understand they are, basically,
I know there's
of
a
a company
partnership,
that
right,
buys those loans, And the FDIC makes the basic policies governing the concentration of loans, or at least they set the guidelines on how a bank has to operate. And if they set those rules and arbitrarily change them from time to time as they do, and force the selling of these loans by the bank, which, by the way, if all in the time past, if we had a loan that the guy was making the payments and the property was appraising less, I mean, we rode with him. You know, bad times don't last forever, we hope, or they never had in the past. But now, if the policies the FDIC has basically puts the banks in a position to where they need this liquidity and they need to sell these loans, what's the difference in what the S&L people did in the 1980s than what the policies of the FDIC are doing right now? You don't have to answer that.
Right.
I mean, that's a rhetorical question.
I know. I was hoping.
that what that I hear. Now, this just isn't my thoughts. I hear it every day.
Right.
You know, talking to somebody trying to keep and I know we're talking about community banks because they're the ones that right now are the most vulnerable to this situation. But trying to stay in the community and do what they've always done, be profitable, and lend a service. But they're not. They're being drawn into this by what a lot of people see as an inside game, just like you've described that the S&L people did in the 1980s. That's the frustration. Pass on for us, you know, when you're talking to them. You know, what's the difference in what happened in the 1980s and what's happening now, other than our federal government is doing it instead of some unscrupulous people? Who's next? Uh-oh. All right, Chairman Earhart.
I don't know about the uh-oh.
Yeah, I forget to turn this mic off.
Thank you, Mr. Chairman. Thank you, Commissioner Braswell. I want to ask a question. Somewhat back to we keep utilizing the terms performing loan that maybe is non-accrual. There's a lot of different specific definitions for those. Let me make sure I understand the way this is working. We're talking about the contractual obligations. When a borrower comes in, they sign a significant set of contractual documents with the bank, with the credit union, and that's your contract. But it sounds to me, if I understand it correctly, and I'm starting to follow this a little bit differently, the FDIC comes in and says, or effectively defaults a loan. So is it the case that what the secondary market is buying is just the $10 million worth of debt and not all the contractual paperwork at that point? They're buying the dollars, but the individual borrower no longer has those same contractual rights they signed with a bank because the FDIC has said, well, we've changed the rules. This loan is now default, or this loan doesn't have the capital. Let's say that capital requirement wasn't a part of the term note that the bank had made for that individual borrower, but the FDIC has now come in and said, well, we want different capital requirements. It's effectively they're defaulting that individual borrower's note, and they're selling that note to the secondary market, and they're just selling, okay, you can go pursue every avenue that you want, and you don't have any of this contractual paper there, or is that not the case?
I don't think that is the case. No, I would disagree with the term defaulting the note. The FDIC would not default, or require or label a loan as in default or require one to be defaulted. What the FDIC and the state does when they come in to do an examination, they review all the credit, a significant portion of the credits, the larger credits especially, or the problem credits, and they classify them either substandard, doubtful, or loss. That
Understood.
Sort of thing. And so that would be different than stating this loan is in default, this one's not. That may be a reason for the classification as a loan is in default, or the loan may be current but be propped up by interest reserve, but it's a subdivision that's a PVC farm in which there's absolutely no activity and there's no other source of income to service the debt. And so as soon as that interest reserve runs out, it's going to default.
Okay, so the bank has certain obligations to that borrower at that point. The bank has to is constrained by the same set of contracts that they signed. Let me ask a specific question. Do you know whether the secondary market has to participate in that same set of contractual restrictions?
What they sell is that note.
So they're just selling the money. They're not selling the contract?
No, I'm saying they sell the contract, the note. The note that you sign with the terms of the contract is what they're basically selling. And so those same...
They can't change it whatsoever. There's no change in that contract when it goes over to that individual secondary market.
It could be renegotiated if borrower and the purchaser, agreed.
Right, the secondary market debt collector and the purchaser...
or the borrower and the purchaser...
Could individually change
right,
it. But,
if they want to.
But it's not unilaterally changed by either the bank nor the secondary purchaser.
That's correct. That's correct.
Is there typically something in these notes, not being a developer, when it's real estate, that the interest rate could be changed if it's sold? Is that a feature that you typically find in a note like that?
I'm not aware of that.
Because I have been told of interest rates changing arbitrarily. Now, whether they have or not, I'd have no knowledge.
Right.
I didn't know if that was a feature that...
I'm not aware
one of the things that sometimes we've all signed things that we hadn't read or reviewed like we probably should have, and found out later that there was something in it that we didn't think. Representative Williams.
Thank you, Mr. Chairman. Mr. Commissioner, I've got a couple of questions as well, but following up on Chairman Morris's and Representative Chairman Earhart's question, I've been told by people representing one side of this issue that as soon as a non-bank entity purchases one of these loan agreements, that they're immediately putting that saying that loan's in default and changing the terms. Are you aware of any example of that happening?
Well, if the loan is in default,
I'm talking about what's my understanding that it's a performing loan. They're not in terms. As I understand it, a loan goes in default when it's not paid as agreed. If there's a failure to provide insurance on any improvements on the property as pre-agreed in the note, or if there's not a payment of property taxes. So as long as the note's being paid as agreed, property taxes are paid and current, and the insurance policy, if it's improvements on the property, is in place. Well, the appraised value trigger is not it doesn't necessarily have to be in the note, as I understand it. There might be a condition of the note that's pre-agreed upon between the borrower and the lender that might have some cash flow covenants and things like that. But the typical note, as I understand it, is paid as agreed, insurance, property taxes, and I've been told that these notes have been purchased and immediately put into default by the purchaser of the note. I find that hard to believe because it's my understanding that the note, being a negotiable instrument, all we're talking about here is trading debt, correct? Are you aware of any examples where this has happened?
I'm not aware of any that fit the scenario that you described. I'm not.
Because is it not true that we're talking about trading legal negotiable debt instruments, and is it not true it's very analogous to our corporate bond market? All we're doing is trading debt there. Is it not true it's very analogous to our municipal bond market? All we're doing is trading debt there. And when those sets of economic cycles come and go, and we might be able to buy at a deeply discounted, call it junk bond price, the corporate securities of a company that's having severe economic duress, we're buying at a huge discount to the original offering or par value of the bond deal. Then all of a sudden, we're gambling at that point when we're buying that debt. And every one of our 401ks buy debt. We can buy it individually. Teachers' retirement plans, everybody else is participating in these debt markets. So the conditions have to follow. The conditions of the loan have to be following these debt instruments if, in fact, whomever is buying these debt instruments and not following those conditions, and I got a huge problem with that. People have told me that those conditions are going on. but I haven't seen any clear examples of it. And that's the one point I wanted to address. The other thing I want to speak to Chairman Morris is an illustration of when a failed institution fails, FDIC comes in. I just want to remind everybody the sole purpose of the FDIC originally, and that's morphed into something much different, is the Federal Deposit Insurance Corporation. And the sole reason for it being organized was to ensure our hard-earned deposits that would give us a knowledge of safety of the banking system. All the FDIC guarantees us with that insurance is that you get your principal back. If you put $100,000 on deposit or $5,000 on deposit, you get your money back. They're not going to guarantee any interest rate. The contract with the FDIC, or the implied contract, is that you get your money back. So yes, the CD goes away, but the money would otherwise be gone. If you're looking to the institution that's just failed, there's not the cash there to make good on the CD. So the FDIC is performing their part of the agreement with the American public by giving your CD principal balance back. Now, if the acquiring institution wants to come in and renegotiate, well, yeah, we'd like to keep your funds on deposit, this is the rate we'll offer you. It's up to the the lender, because you put your money on deposit, to either take that new rate or not. Am I correct on the way I've addressed that aspect of the equation? Because I just want to make it clear there's not two sets of rules between the deposit function and the loan function of the bank.
That is correct.
Okay.
Well, that's technically correct, but my point that I'm making is that when the FDIC has a policy and runs the loss share, I mean, it doesn't make any sense and I will agree with one thing you said. They're an insurance company. That's really what they're supposed to do. They're supposed to take premiums and pay claims. But by the policies that they're doing, they're giving us one set of rules from down here and operating with another set of rules up there. I understand technically when the bank is gone and you have the loss share agreement, you have a new bank, and that contract is not the same. They've made that obligation, but they made the policy that made that transaction happen.
Mr. Chairman, I want to make sure everybody's perfectly clear. I'm not defending the FDIC.
Yeah, okay. All right. Well, I'm glad you got that opportunity because we were beginning to wonder. All right. Let me, I wasn't, I don't mean to say I wasn't listening to what you were saying, but as you were saying what you were saying, if there was a dispute, if there was an action based on a secondary buyer in the collection of the collateral or however they were going to make themselves whole, is there any regulatory? There's no regulatory. I know we have the governor's what do you call it for consumers?
Office of Consumer Affairs.
Office of Consumer Affairs. But if a person who felt like they were wronged, is basically the only option court, or is there some governmental oversight that would apply to this process between a borrower and a successor creditor that you're aware of?
If it was a non-regulated entity, like say sold to a non-bank, basically, then it would, fall under. It'd be just a civil matter to your attorney, Federal Trade Commission, or something of that nature. It would not fall under us or the FDIC, that sort of. There'd be no regulator that
we'll leave that.
Oversees that private party.
Thank you. Chairman Houston.
If suppose my daughter had a loan and she couldn't make the payments, could I go buy the loan? If the bank was going to sell the loan, could I buy it, or would it have to be sold to a certain type of market?
No, they would be able to sell that to you, or have you. They probably what they do is make you a loan
That'd make me take over the loan.
Right.
Instead of selling it to me, I'd have to take over payments. I mean, I'd have to take the whole loan off. But why couldn't I buy it just as good as a secondary market?
Yeah, well, what they would do, like say, is probably make you a loan to pay off your daughter's loan and that sort of thing. That way, you could have negotiated what is collateral and what is not. That's the way that would be handled.
No, but what I'm saying is, I should have the right to buy it just as good at the same price as the secondary market should buy it.
Right.
But that's not what would happen, is it?
I don't know. That's
okay,
a good question. I'm not sure.
Scratch that. Okay.
Thank you. Chairman Knight.
Thank you, Mr. Chairman. A follow-up on Representative Earhart and Representative Williams' question, going back to the loan document, the original loan document and the contract. I'm getting some conflicting, I guess, I'm hearing of conflict there that in the case of a loan where somebody is servicing the debt, the amortization, whatever its schedule is being met, they're paying principal and interest down. But in that case where the collateral lost value, okay, and FDIC, state, whatever comes, lumps it into one of the subpar categories, and that loan is then sold. What is it in that contractual, in that loan or in the loan contract? Is there a clause specifically in the loans that say if collateral falls below a certain percentage of the loan, then the loan is callable? And I'm getting conflict because I've talked to someone that said, yes, that is a reason to call a loan, and that gives the third party a reason to call a loan.
Right. Well, it all depends on what is actually the terms of the contract. If that's in the contract, yes, it is. If it's not in the contract, no, it's not.
Okay.
I'm prepared to argue. I bet virtually every time the property tax is
That's what I want to make sure. It depends on the individual loan, and if that clause was in the loan, is that enough to trigger default in the loan, so that whether it's the bank or whether it's the bank's going to work with. Usually the bank is going to work with the developer or the person taking the loan maker, but when it gets to a secondary or third party who's bought it, that's where they could trigger default if that clause is in there, right?
Correct.
Okay.
Representative Flood.
Thank you, Mr. Chairman. We are clear on how this process works. Loans are made for automobiles, credit cards, homes, a variety of reasons, and those loans across the board are typically sold in a secondary market. And is it correct to say that those loans are not sold necessarily individually, but they're sold in bundles? And so they sold as a part of a package that then an investor group, whether it's one entity, one individual, or one company, buys a pool of loans. And they don't know whether Virgil Flood's home and Tyrone or his car or whatever is a part of that. They just know that there are loans with varying kinds of assets in them. So what we're talking about is a kind of a natural process that happens in the financial services sector pretty much every day. And loans are not necessarily singled out when the transaction for one loan to be sold to a secondary market when that occurs.
You're correct that usually they're sold in pools of loans. You're exactly right, bundles. Now, many institutions, you mentioned like car loans, credit card loan, whatever type of loan, mortgage loan, they may keep those on their books. Like say in this environment is where many have needed to reduce the size of their portfolio, redistribute their portfolio to reduce the concentration, or like say need to cleanse their books and get some of the problem assets off their books. And so that's when they're usually sold. Your average small community bank would not typically sell the loans that, you know, if you walked in and made a car loan, they would not typically sell that.
So they would primarily now be focusing on selling the non-performing loans because of liquidity.
Lately, that has been trying to reduce the number of problem assets on their books. They would do that, yes.
And just so I understand, the faltering of banks, the loss, the number of banks that have failed, are not attributed to the FDIC in any way. Those banks failed because of loans that wound up being non-performing assets, and not because of anything the FDIC did.
That's correct. Others would say that some of the policies may have made the situation, exacerbated the situation, or not helped some of those that were struggling to turn around and return to healthy status, but instead they kind of created a death spiral, if you will, because I don't think when the prompt corrective action measures, which the FDIC and the regulators have, but the FDIC has instituted, was not, it was intended to prevent, it was intended to, when banks hit certain thresholds on the going down, that it would kind of prevent a further deterioration, and so require remedial action and corrective action so they return to healthy status. What we have found out when you have such a severe environment, which we've gone through the last 4 years, what it does is once they get below certain thresholds, it's very difficult to turn that around. And they have, many institutions have been caught in what we call the death spiral.
They were already performing at a less than satisfactory level, and it hastened that demise.
Yes, exactly. And the reason you're exactly right is that the loans could not be repaid, especially here in Georgia and throughout the country. They're mostly real estate related loans, subdivision related loans.
Thank you.
Mm-hmm.
But in defense, I would say, thank you, the same loans that turned out to be bad in 2008, I mean, typically when the FDIC came in and did their periodic audits, I mean, they didn't see it coming either. I mean, we had really good, they were all classified as great loans, up until the economy went bad and we failed. I think the point that you made about going from that point forward,
right,
is the points that I've made.
Right.
The flaws in the handling, I believe, of disposition of the assets of the banks that were taken over without purchasers, and I would say the short-sightedness of the loss share policy and what it has done to community banks. It's just always been difficult to us to see. Again, I gave the example of the big Wall Street banks, right, that were bailed out, and whether you believe that should have happened or not is something to debate, but it's still difficult for me to see how someone from a community far, far away from the one which I live would be better suited to be in effect bailed out with a loss share agreement than coming in with the people who had ran the bank profitably from 1929 and 2009 and allowing them to use the capital to regroup and come back stronger.
Right.
I guess that's the nail down to the point that I would make. But all that's hindsight. We're talking about going forward.
Right.
So that would, all those concerns I think that the committee has expressed, I would certainly hope that we could see these policies improved for the health of the banks and for everybody that's doing business with banks, which is why we're here.
I think what
with this bill,
kind of alluding to open bank assistance, and that is something that many states, including ours, have spoken to the FDIC about, asking if that's a possibility. And I know that went all the way up the chain to the chairman up in Washington regarding that, because many institutions feel the same way, that if capital, a lesser amount of capital could have been plugged into those institutions, or while the bank is still open, that they would have remained viable. Whether new management needed to be in there or not, that would be on a case-by-case basis. But that is not something that they are willing to do.
Yes. Okay. Well, as present, there are no more questions. No more questions. Commissioner, like you were on trial, maybe. I hope it certainly wasn't that way. I appreciate your coming. It was a very good meeting, and I appreciate the committee. Very, very good questions. Again, tomorrow, I'm sure most folks here will be interested. What room number? What room number are we meeting at tomorrow? Same one, 406. We'll be here from 1 to 3. An hour allocated for those supporting the bill, an hour allocated for those opposed. Again, thank the committee. Thank you, committee, for a good meeting. This meeting's adjourned.